Welcome back to the channel, folks. This is Jason, certified financial planner and host of Fighting Words Financial. Today I'm going to follow up my XPeng no hype update with a Nio no hype update. So Nio was up a little bit today on news that doesn't seem so spectacular, but it kind of is, and I'll get to that later. But before we get started, I do want you to keep in mind that markets in the short term don't have to behave rationally, and they certainly can behave irrationally for longer than many investors can stomach. Folks, this is normal when you're investing in high volatility stocks like this. The price goes up and down. If you're a long-term investor like I am, like I don't even look at my brokerage accounts on a daily basis, on a weekly basis. I might look at them about twice a month, and that's usually when I go and buy something. I usually hold things pretty much forever. That's my timeline, and I don't do a lot of selling. So I'm going to recap some of the reasons that Li and XPeng declined recently. A lot of those reasons are more general and not specific to Nio, and so they apply to Nio as well. If you saw my video yesterday on XPeng, you can skip ahead to the stuff that's more specific to Nio. If you haven't subscribed to my channel yet, though, I would really appreciate that. And if you would hit that like button too, that would make my day. So the sell-off with Nio really started on November 24th on no news whatsoever. But it appeared to be a lot of profit taking and end of year rebalancing. That sell-off was accelerated on November 30th when the Chinese government announced that their top economic planning body was going to investigate Evergrande Auto, which is not well known here in the US, but it's a key player in the EV world in China. The move didn't really have anything to do with Nio, but it's just a little bit more bad news. On December 1st, Hindenburg Research put out a report absolutely wrecking Candy Technologies. Once again, that has nothing to do with Nio, but fear is contagious, and it did drag on the share price. But December 2nd was really a terrible day for Chinese electric vehicles. On December 2nd, like I predicted, Li Auto announced that they were going to issue another 47 million shares to the public, diluting current shareholder equity. And when I published my video yesterday, I did it really late in the evening. Actually, I did it really late in the evening Sunday night. But a little more than 4 hours after I released that last video predicting that XPeng would do the same, XPeng sent out a press release saying that they intend to raise $2 billion through a secondary offering as well. So at this point, I think it's almost a certainty that Nio is going to do the same. There's a number of reasons why. I know a lot of people just seem to think that they're not going to do it because William Li said there's no need for a secondary offering. I can't tell you how many times Elon Musk said that, but they basically raise money with secondary offerings or with convertible bonds every year in their existence except for 2018. I think that was the only year where they didn't do that. But the hits just kept rolling for the EV sector in China in December. On that same day, December 2nd, UBS downgraded XPeng, and that had an effect on all the share prices for EV makers in China. And the U.S. House of Representatives passed a bill that would delist Chinese companies listed on U.S. exchanges unless regulators in the United States, or at least approved by the United States, were allowed to inspect financial audits sometime within the next 3 years. That's a lot of bad news in a really short period, but in actuality, little of it has anything directly to do with Nio, with the exception of delisting. As several members of this investment community have pointed out, however, Nio has actually been moving towards full SEC compliance for months. This is based on the statements of William Li himself, and they've kept up with SEC filings, and you can see evidence of that on their website. I don't know for a fact if this represents full compliance. That remains to be seen, but I think it's a healthy step in the right direction. They're showing that they're willing to be compliant. Once again, all of that bad news caused the market to completely ignore the good news. We've all heard the good news now about Nio delivery and sales. I'm not going to rehash that other than to say that the numbers look more than good, and I'm not trying to diminish them, but the news I'm going to talk about next, while not as exciting, is actually far more important for the future of the company over the next 6 to 12 months. If you guys remember, I did a video last week on VW and auto parts suppliers Bosch and Continental warning about a looming shortage of critical semiconductor components absolutely necessary to EV manufacturing. It was probably going to start affecting production fairly quickly and could actually slow production over the next 6 to 12 months. And I said that BYD was in sort of a competitive advantage situation here. Today, Nio announced that they didn't expect to have their growth plans to be affected at all by this looming shortage of automotive semiconductor components. In a lot of ways, this statement tells me a lot more about the quality of management that Nio has in place than anything that they've said before. They've started thinking about all of the ways they could fail. And that's very, very important. You don't really plan for success. One of the ways to achieve success is to plan for all the ways that you can fail and simply avoid those ways, and you can prevent it. Now, if you recall in that video, I stated that the semiconductor shortage was an opportunity for BYD to grab market share. BYD is the only electric vehicle company that makes its own semiconductors, and in particular the insulated gate bipolar transistor, which is absolutely necessary to EV manufacturing. I felt that this gave BYD a leg up on the competition, as they weren't going to have any of the supply constraints that all of the other EV manufacturers were probably going to face, and it was going to affect their ability to deliver products in a timely manner. So a senior Nio executive told reporters from China's Financial Associated Press today that the company's actually been preparing for a shortage of automotive semiconductor components for a while, and that the shortage will have no impact for the time being on Nio's plans to expand production amid all of this high demand. You should really pay attention to that statement "for the time being." It could mean a lot of different things, but it only needs to mean for the next 6 to 9 months. As long as Nio has a stockpile of semiconductor components that can last for the next 6 to 9 months until supply catches up to demand, and all of the semiconductor manufacturers in China have agreed to step up their volume of production to meet that demand. As long as they have that 6 to 9 month supply, then it's probably not going to affect their ability to make deliveries. That's good news for Nio and good news for Nio investors. So there it is, folks, your No Hype Nio update for this week. Thank you very much. You can tell me how wrong you think I am in the comments below. I look forward to hearing from you. I'll see you next time.